Ever wonder with all these lines and numbers in stocks, who's actually cracked the code? Let me tell you about a total math genius. Jim Simons, an American. He invented a range trading strategy, and with it, he's hit an average annual return of 80% for 30 years. What does 80% even mean? That's 4 to 5 times the annual returns of Buffett and Soros. And the best part, no need to predict future trends, no need to dig into fundamentals or news. Pretty sweet, right? Just split a stock's trading range into little checkpoints, then mechanically buy and sell at those points, boom, daily profits. Take an example, say a stock bounces between $5 and $7. So there's a $2 gap there. Split that gap into equal parts like $0.5 intervals. If you buy in at $5, sell a chunk when it hits $5.5. Sell another chunk at $6 when it drops back to $5.5. Buy some more at $5, buy even more. Heads up, each chunk should be the same size. As long as the stock's moving, trade those points without It's simple and avoids stupid impulsive moves. But I know what you're thinking. Does this back and forth actually make money? Let's check a real example. This stock hit a low of $6.5 and a high of $11, mostly bouncing between $7 and $10. Split it into 0.5 yuan intervals. And let's break it down like the earlier example. Suppose you buy at $9.5, then buy more at $9 when it drops, and keep buying at $8.5. It drops to $7, then rebounds, sell the shares you bought at $7 when it hits $7.5. Sell the shares you bought at $7.5 when it hits $8. Then the stock drops back to $7.5. Buy back the shares you sold at $8 right at $7.5. Stick to this rule, and as long as the stock keeps moving, the cash keeps rolling in. This stock's max gain in 6 months was $3. Even if you timed it perfectly, buying at the $6.5 low and selling at $11, you'd only make $4.5 per share. But with strict range trading, you'd make over $11 total, sell prices minus total buy prices. Buy on dips, sell on rallies. This back and forth, hedging lowers your cost and piles up profits. What if we shrink the interval? Same stock, $0.2 intervals, buy on $0.2 dips, sell on $0.2 rallies. Theoretically, profits hit $24. It's like non-stop buy low, sell high, but smaller intervals aren't always better. Money's limited. After all, the smaller the intervals, the less money per trade. Frequent trading also racks up huge fees, so balance is key. For newbies, try $0.2 to $0.3 intervals for stocks around $7 to $8. Bigger intervals mean less frequent trading, which is easier. Smaller intervals need more attention, though. Now that you know how to trade, the other big thing is picking stocks. Use the ATR indicator. It measures volatility. The higher the ATR, the more volatile the stock. Pick stocks with big swings. They're the best for this strategy. Long story short, this system is dead simple and it works for everyone. It thrives in sideways, choppy markets. The bigger the swings, the more you make. Theoretically, smaller intervals equals more profits too. But plan based on your cash and the stock's historical daily moves. Heads up, it does not work in these two scenarios. Last thing, if you pick this strategy, stick to IT. That's more important than anything. Don't chicken out on buying dips, and don't get greedy on rallies. Sell when you should. For anyone wanting more stock tips, my personal contact info is in the comments.